Hello, everyone. It's a good afternoon today. Let's get into it. This is week 19. Alright, and we'll start with Sunday, what my analysis was. So, at the beginning of the week, I was interested in lower prices, and I did talk about how over here the bullish the summer was. It's possible that we disrespect the seasonal tendency of usually going lower in the summer and then just continue to push higher, right? Because if we're in a seasonal tendency to go lower, but we're going higher, it means there's extremely strong higher prices, and it would take a lot to be bearish. Therefore, I was waiting for some kind of confirmation, like a huge confirmation that we would be bearish, right? So I was seeing SMT, Smart Money Technique, a higher high with the Nasdaq making it, and I repeatedly mentioned how if we are in a bearish market, usually the Nasdaq should be leading, making those lower highs, and the Dow making the higher highs. But instead, you see the Nasdaq is getting pulled down by the Dow a little bit, by the Dow Jones Index, and so that's causing a little bit of consolidation or more down close candles than you usually would see in an up close market or in a bullish market. So there was reason to still continue going higher. And this is the weekly chart. As you see, what did I say for the weekly chart? It's clearly in a bullish trend, and we have trouble displacing with speed and distance above swing highs. So I was mentioning how this came down and closed near that high. So I said that if we're gonna continue this bullish trend, we don't want to see that trouble. We want to continue closing higher and see more bullish candles. If we start to fill and we start to show down close candles, in the week that just passed, we had closed lower, then I could be more confident to see lower prices coming into the future. Here's the 4-hour chart. Just a trend higher, so there was a lot of low resistance liquidity. I wanted to see some measure of sell side being taken before going higher, maybe like maybe this first low over here to sort of stop this trend and make some people the price isn't going to keep going up forever, right? So I was just waiting for maybe some low of the week to be formed ahead of all the news that we had during the week, right? Or price to head up and then go lower from the news. So those were the two scenarios in my head. And then I talked about how dollar had found momentum. It bounced off a weekly bullish order block, which this is the weekly chart. So that all these three down close candles there, 1, 2, 3. Dollar bounced off that area, and it found a lot of support. Well, it bounced off here, and then it came back again, and is bouncing from here. There's this inverse fair value gap, which has my attention, and the reclaimed order block. I want to see if we're willing to get above that and make a quick run to buy side liquidity. And now higher dollar is a risk-on scenario for assets like the stock market, so it would be harder for the stock market to see continued rallies when the dollar is trading higher. And I don't know actually if it's still trading higher. I didn't take a look at how it closed. So it is actually still going higher this week. Okay, and you can also tell by where the bodies are. If you see the wicks are making those lower lows, but the body's making higher highs, and so it's showing that there's a lot of bullish pressure with the dollar, and there's also geopolitical reasons, economic reasons why the dollar is trading higher, or we will see the dollar trade higher. And bonds also seem to be picking up with the dollar. Usually these move together with stocks, but you see, I was gonna delete this because bonds. ICT made a video in core mentorship where he talked about how the bonds, the dollar, and the stocks go up in the same direction. But that's not what he said in the 2023 mentorship. I think he was talking about long term for a swing trader. They should go up we're talking about long term position trading, like for the next years or months. Yeah, then okay. But inside of a day, if you see the dollar rise, or inside of a week, or inside of a month, usually it's going to be the other direction for the other assets because of they're priced in dollars. So the dollar get strengthening, anything priced in dollar is going to go down, which is, the bonds though were sort of, and again I did not look at how the bonds traded, but I was looking at the bonds and I said they seem to be picking up a little bit. They're having a lot of trouble picking up, but they seem that they're respecting this inverse fair value gap here. They're bouncing from it, and we are still closing higher above these down close candles. So there's still reason to believe that we could go higher. However, we also have a lot of PD arrays, so it's not really clear. It's more two-sided on the bonds. So let me delete this, and also let me check how the bonds closed, because I did not check that either. So okay, yeah, they did also go higher, so they are picking up with the dollar, and usually that, well, I don't actually know if the bonds, yeah, they're priced in dollars, but I don't know what that means, the pricing there. But anyways, we're now on to Monday. So this is the daily chart for Monday, how it closed. Right, we're showing that immediately these down close candles that we left Thursday and Friday from last week, we're not willing to continue that momentum lower. So the Friday momentum that started draw lower, we're not willing to do that. And we had an inside day. So immediately I'm looking at the low and high of Friday, and I'm identifying that there's a lot of liquidity there, and that's what's on my mind going into the next day. All right, but going to today, I get up and I see 9 a.m. I noticed that we had made that run on that Friday afternoon low into the rejection block, and we found support. The fact that we retraced here showed me, okay, we could be seeing a reversal, right, because we have a short-term low that was taken out. We have a higher time frame discount array, the rejection block there, that was traded to, and now we have a reaction higher, leaving a 1 hour fair value gap. So there's a fair value gap there, that candle. I think that is the 7 a.m. or 6 a.m. candle, but I was looking at that 1 hour fair value gap, and I was looking at this one over here, which should be the 3 a.m. or 2 a.m. Candle. No, this is midnight, so this should be the 1 a.m. actually. Maybe no, this is 2 a.m. So I was looking at 2 a.m. candle, drawing lower. That moved lower, and I was looking at that fair value gap on it, and so I saw price bounced from it, closed beneath this fair value gap. So now there would be a lot of reason to go lower and see a trade to that new low, but we failed to do that. And I waited until the 10 o'clock hour. We failed to go down there, and we left a wick. And the other indices, I believe, did trade beneath this low, so there was SMT here. And that, when you see a failure to trade to this low, having already reason enough to go higher, that's usually a bit bullish, and we usually see a bigger retracement because we failed to go down beneath this low and we left a relatively equal lows. We see like an attempt usually back to discount. So we went back to midnight open in the afternoon into a discount, and then we continue to trade higher. But I wanted to get in. I remember I made a video, and I was I don't know if I don't know if it was a live trading video or whatever, but I showed that I was trying to trade this inside a Monday. Now this was 2 days ahead of the news, and usually when you have high impact news like FOMC and CPI, you want to be careful 2 days ahead. I don't remember if we had news on Monday, but I'll usually trade. Monday we had no news, so usually I don't mind trading 2 days ahead if I can see something. But the day before I will never trade. But usually like 2 days ahead, this is where you want to be careful. You want to start to be careful and have smaller expectations for the amount of points that price is going to move to. As you see, we had an inside day with Friday. That's because price is the most of the volume, the liquidity, the volatility is going to come after the news. But we created this down close candle into the consequent encroachment. So if you go on the 1 hour chart or 15-minute chart, that's a consequent encroachment right there. After bouncing from that, we create the order block, and I'm trying to get in around 10 o'clock using this order block. You see that's the trade I took. So I waited. I wasn't confident to take the trade down here, but when it expanded again and it closed above this fair value gap, I saw this inverse fair value gap there. I saw the order block. I saw this fair value gap here, and I saw this fair value gap there, and I decided, okay, this should be enough levels to where I can put my stop beneath this level, and it ended up wicking down there. So this was the trade, and you see it came down beneath it just a couple points, and it continued to go higher. So I was right in the bias. I was right in the direction of where price wanted to go, but I still took a loss. Right. The good news is that actually there was an outage. I took the trade on Apex. It was an eval, not a performance account. So because of that, there was a outage, and so they're restoring the account. And I still have it the same P&L as when I started the week. So I will be continuing to trade that next week. But yeah, I got lucky because I talked about what happened on Monday, where it because of this loss, it led me up here to completely change my bias and start to revenge trade, and I ended up taking losing a lot more than I wanted to. But thankfully, I'm okay because I got lucky, and I still have this trade never happened because of the outage that they had. So I get another chance. In the afternoon, the price action was not bad. Where we have lunch session highs here that price trades to. If you look at the lunch session from 12 to 13:30, we have that low. We fail to get to the high. We come back to that low, and then we make an attempt to the highs. So you see over here we have the midnight open. It trades back to, and then you can use anything you want to get in. There's not much retracement. It's really nice and quick, and it doesn't do anything else. Right, so you'll often have scenarios like this, by the way, where we can kind of consolidate and we chop around, we grab the low end, go back to the high end ahead of volatility. Right, but anyways, Tuesday, again, more expansion higher. Now, I said I would be interested for tomorrow to create the high of the week. Right, obviously that did not happen, but I wanted to see if maybe it would reverse. That's why I said high of the week. And then as the week continued, I had forgotten this bias that this would not be the high of the week because it obviously did not reverse. There was CPI and FOMC in the same day, so two very high impact news: the inflation rate and also the interest rate. The meeting that they basically talk about the monetary policy and what they're going to do with the rates in the future. But all this created a lot of volatility, and there was two separate expansions higher in the same day, which led me to that's Wednesday. So let me just talk about Tuesday. I'm getting ahead of myself. The 9 a.m. candle qualified. I thought this was Wednesday for a second because of how bullish the candle was. But yeah, very bullish candle, expanding way above the highs. And then we qualified an order block, we traced back to it, and respecting inverse fair value gap. So hourly order block being traded, going down into the fair value gap from the hourly chart, and then there's also a rejection block if you want to try and use that. So the hourly candle drops down into this inverse fair value gap in yellow, and then we continue to trade higher. We create a market shift. We come back, hit the order block, right? The wick, not the body, but we hit the wick. Bodies are respecting this inverse fair value gap, and we continue to run higher. Notice the balanced price range too. When we got up yesterday into this balanced price range and traded around it, this is balanced, right? So there's no need to come back to this area. If price comes back to this area, usually it fills the whole thing, and it usually spends a lot of time. Most of the time, it's going to go to the highs, or it's going to go for something higher. So we got above the balanced price range, came back, and then continued to trade higher in the afternoon. All right, which ahead of CPI, this is oftentimes I say when we have high impact news, the next day we'll either see a very bad day or we'll see a very fast and explosive day. So I did paper trade this day because I did anticipate large ranges and violent price action. But we come down to these down close candles from yesterday that I was trying to trade off of, and we bounce from there again, we get down to this low here, and we continue to trade higher up to yesterday's high. Sorry for the cough. And we trade back down to discount, right? The 50% there from that low to that high. Now, I would also consider discount being from this low up to this high, or even the buy side liquidity high up there. The reason I'd consider this high is because that's a high that took out buy side liquidity, Asia high, down to the low, which took out sell side liquidity, or sell side PD array, which is down here, right? The order block in a discount. So these two measures of premium and discount, that high to that low, that's what I could also use for a discount. Which in that case, it did not come back discount. It came back to this fair value gap, and it continued to trade higher in the afternoon. This is the trade that I took. So we have the morning, which consolidates, and we trade higher into the hourly fair value gap. So here, and then 9:30 opens up, sends price lower, delivers lower, and we make a low into the hourly fair value gap. We make an initial attempt higher, we leave a fair value gap, and then we leave another bearish fair value gap, disrespecting that bullish fair value gap. So this is like a fake run, like to get people excited, to get people buying in too early. So a fake run to then bring it right back down, and then basically fake everyone out, make everyone think it's going to go up, but then nope. Once that happens, then it has an order block that it can use, right? Those down close candles becomes an order block, and it comes back, gets above it, comes back, uses it as support, and it continues to run higher. Show the 30-second chart here. There's the inverse fair value gap, and that's the initial run higher. Come back beneath it, fair value gap there, inverse fair value gap as soon as we close above it, and seeing the run higher to the buy side liquidity. All right, so that was Tuesday. And again, this is not a real trade. This is a paper trade because there was high impact news the next day, so I would not ever trade live funds on the day before the news. But Wednesday, right? We had the high impact news, 8:30 in the morning, CPI, 2 and 2:30 p.m. We have the FOMC, and usually 2 p.m., 2:30 p.m. There's no trading. I don't trade until 2:45. When there's FOMC, I wait 15 minutes until 2:30, and usually it comes to question time at 2:45, and so that's when price starts to actually deliver. And the last hour usually is where it goes into the last hour, and it uses that macro to deliver price. But during the 2 to 2:45, it's mostly just noise, I guess. Price just moving back and forth, setting up for a move. But it's very volatile, so yeah. Today drastically expand higher, huge. But usually before 2:45, I mean, price can still, I've seen price give really good setups before 2:45, but it's just usually very volatile, and it's moving like large ranges, overshooting sometimes a lot. So it's just better to wait till the volatility dies down, and then the real move can occur. But you see what I was talking about, how large this candle was. We went from the low 200s, the low 19,000s to the high, I guess not really high, but more premium, about 400 points. Right, so pretty huge move. And this is the CPI move, and this is the FOMC move. The CPI move, we got a softer print than expected. So if you look at the CPI, we expected 0.3%. We got 3.4%, and we got 3.3%. So this was a miss, and so the market's looking at that and saying, whoa, inflation is coming down. I'm saying inflation is coming down faster than the Fed thought, and so that means that they're going to cut rates earlier. I have a video on that coming up. This is not true, but even though the inflation's coming down, asset prices are soaring because everyone's buying them thinking the Fed are going to cut the rates. But when they realize that the Fed is not going to cut the rates, well, they're going to need to spend more because they're gonna start to pay a lot more for borrowing money and for the what they pay for their mortgages and any loan they have. And so then they're going to run out of money eventually. So they're gonna have to sell a lot of stocks. So I mean, I don't see this inflation rate going all the way back down 2%. Again, I can make a video on that, but I have a presentation ready for that. And the rates are definitely not coming down until people still think that the inflation is headed back down to 2%. But anyways, that could lead to these huge moves becoming more and more like dinosaurs, and we start to see them the other way around eventually. But anyways, price retraced into Asia range, 75%, failing to get to its low. So you see this is the Asia range. We had a little bit of an Asia range. It's moved quite a lot, especially, well, actually, no, this is because I'm zoomed in, and because the CPI went up so much. But still, it mostly consolidated overnight. So we had London attempt to get beneath it. We failed to get beneath it. And this is similar to Monday's scenario. So right before CPI, right, what do you think people are seeing over here? They see it short. It initially works, then it fails right ahead of CPI. But it's making these higher highs. So the fact that it's rejection, I was trying to speculate CPI, and I thought it would go lower. I thought it was going to go down, and it completely, I look at it, and yeah, it did come back down to the inverse fair value gap. That inverse fair value gap there, it found support. But if I had to, if you put a gun to my head and I had to ask you, you had to ask me where it would go, I wouldn't be able to tell you. There was no real reason to see it go lower, and there was no real reason for me to see it higher from just looking at the technical analysis in the chart. And it went extremely high. So once the print came out, it made an initial explosive volatility. I wanted to see if this premium bullish short block on the 15-second was to be broken, used as a resistance. So I do this often. Whenever we have a huge news print and we have a lot of volatility, I go on the smaller time frame, 15 seconds chart, since there's a lot of volatility, and I try and treat it like a 15-minute chart. And this works because price is fractal. So if you look at a daily chart, weekly chart, monthly chart, it'll work the same as a daily chart, and so on. It's fractal. It moves in relationship with each other, and it moves the same. So a 15-minute chart, right, inside of an hour, 60 minutes. Well, inside of a minute, 60 seconds. The 15-second chart theoretically should work the same as a 15-minute chart. So I was looking at this 15-minute order block, and I said if this gets broken, we have low resistance liquidity. We have these higher lows being formed. We had initial attempt higher, leaving an order block, but it's in premium, right? Premium compared to this low up to that high. So if we get beneath it, we close beneath it, I would look to go short. So I went short early, right? Around 42. So, 24. So around right there, right underneath that up close candle, and we disrespected it, and we left a huge fair value gap. And then I was tapering this whole thing, but if I were to go down to the 5-minute chart after the 15-minute PD array breaks, I wait to see a short-term low on the 5-minute chart be broken. So we had an initial run up, leaving a fair value gap, getting people long, and then we have that 5-minute short-term low, give the initial signal lower, and then we come right back above it to then truly go lower, make people think that we're trending higher, that we're in a bullish trend, creating liquidity, people entering the markets as a counterparty to smart money or me, which takes price lower down to complete a market maker sell model. And I took profit basically at this low. I didn't take profit over here at this low because I had just gotten in and it went down there really, really quickly. So this is like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 50 seconds. Not even a minute. And I wanted to see if it were to come back to the 15-minute chart, the PD array on the 15-minute chart, and then use that as resistance and then continue to go lower. So this is the 15-minute chart. the real 15-minute chart, not the 15-second chart, after CPI. So you see we had the 9:30 open after CPI ran up, and we expanded higher. This fair value gap from the high of that candle to the low of this candle, the gap here in the middle candle, 50% of it, that's consequent encroachment. Price found the resistance at that level, and we're in a consolidation ahead of FOMC. So watch this whole, after 10 o'clock, this whole sideways movement, right? We during FOMC at 14 o'clock, we initially run down to this level, and then we come up, make a high, we come all the way down, creating an order block, rejecting the order block, but then continuing to go higher. So we really chopped around a lot of people. This is why you need to be very, very careful when you're trading FOMC, because not only is it very manipulated, it can offer very good trades, but they're huge ranges. So if you get it wrong, you might be very, very wrong, right? And sometimes it was more than you actually, especially if you start revenge trading it, it can be very bad. So usually I try and avoid these, but as you can see, after FOMC, after the most of the news release, there was lots of movement, and there was good trades you could have looked to take. So this is the 14:45 when I started to trade. We had this 1 minute wick, which is a large wick. We bounced off the consequent encroachment. When I noticed that, I kept it on my chart. We came back to the order block a couple times, bounced off the consequent encroachment again, and we left relative equal lows. I said when I recorded this live, I would have wanted to go long on that inverse fair value gap, but because we had relative equal lows, I was saving any trade ideas to get down to the relative equal lows, because I didn't like how they were there. It made me feel uncomfortable about doing anything with this gap and higher prices as long as they were relative equal lows, or like equal lows. These were too clean, and we did come back down, but we gave no opportunity for me to enter because it just went down so fast. And this was manipulation to then a higher move, and I didn't expect the higher move, right? Because we had came down so fast, and I thought that it would be out of steam. This happened at the end of market close, but there was apparently this is exactly at 16:15, so there was probably some earnings or something which gave price more volatility to continue running higher. But I just expected a retracement or a continuation lower to that blue area there, that fair value gap. All right, and Thursday. So this is a terrible day. Usually the news comes out, and that's after the news when the higher probability days are. So looking ahead in the week, I thought, okay, Wednesday is going to be good after the news, and then Thursday and Friday, those are going to be the best days. But because Thursday had no news and we had expanded like 400 points in one day, you see we didn't really do much. We didn't do anything at all. It looked like a Monday. Even Tuesday has news better than Thursday. So we had a very much of an inside day. And that's normal because we expanded so much. So you see this is not really looking appealing at all. This was taking at 2 hours before market close though, so there was 2 more hourly candles to print, and that's why it looks a little shorter than the other days. But you have the midnight open, which when we get above, I was looking in the morning to get one more time run back above this high, and I wanted to position myself above that midnight open to take it lower, right? But we unfortunately did not get that. As you can see, the reason I wanted to see another run at the buy side liquidity was because this wick here is what traded the buy side liquidity. And whenever I see huge wicks like this, I usually ignore them. I look at the constant encroachment, I look at the PD race off of it, but usually it's gonna usually leave relative equal lows or highs, sorry. And if you go to a line chart, you're gonna see that the bodies don't get anywhere near this high. And so it's showing a trend lower, which is a low resistance liquidity run. So when I see these huge wicks like that, I want the bodies to come through them and close up there. I want the bodies to fill the wicks because that's the way easy way of thinking about it. Just because these wicks have unfinished business, more liquidity they need to clean up, and it gives the impression as if there's a lot of selling pressure up here, which is liquidity, and it's trade ideas. When it gets up there will be orders there, and there will be new orders created based off what happened in history. And if we break above these wicks, people are going to think that the selling pressure is gone, and they're going to look to buy when price is going to reverse and go lower. But at the end of the afternoon, before the market closed, you can see I was framing an order block here that price bounced off of. This is a higher time frame, probably hourly chart. Yeah, our hourly chart. And there was a short-term low, which we took out. Bodies closed beneath that short-term low, and then we continue going higher. So like this is an example. We left a huge wick, and then it attempted to get beneath it, hit consequent encroachment, retraced, and it came back down. So I was kind of like looking for the same thing. It hit consequent encroachment, retraced, or went back lower, and now I want it to go above it. But I wanted it to go higher after the 930 move lower beneath these lows, and we didn't get that, unfortunately. So there was no trade there. And on the regular trading hours gap, there was a huge gap that price came down to fill this gap, and there was another gap there, but it found support off that inverse or valley gap. So you can also use the regular trading hours gap, by the way, to look at price action, and instead of just the regular electronic trading hours gap. So regular trading hours gap is just basically 930 open to around 1614 or something. And this is the 5-minute chart. There's a order block there, which mean threshold 50%. We dip down, 930 opens that candle right there to run up to the consequent encroachment, and we run down lower, leaving that short-term low. And in the afternoon, we leave a nice order block, right, around noon. We have a good, decent lunch session, better than most, running up to the afternoon, slowly getting up above this gap. And I wanted to see price close above this gap and continue to climb higher towards the relative equal highs. So sorry. 1 minute chart in the afternoon, 10 o'clock. This gave a initial run lower. I even got fooled by this. I was tape reading, and I thought that price would use this gap to go higher. It was very low probability. I wasn't looking to trade off of it, obviously, because you see we have a gap up here which resists the price, and I said, okay, it could use that gap and go lower, but it could also use this gap and go higher. Because I wanted to see the relative equal highs, I decided that if I had a gun to my head, I would be buying here. So today, if I had tried to trade, it would have been a loss. And we down sell side liquidity, completely running past it after all this consolidation. And yeah, so I think that's it for Thursday. Not much happened on Thursday, but Friday was a pretty good day. We had, I think we had a better afternoon session, obviously, because the London session, if you identify the London session from midnight to 6 a.m., this trended lower very, obviously, Friday had a pretty good trading day because London session expanded lower. So the morning was very bad, but that left open for the noon and afternoon to So Friday was a pretty good day because you see after Thursday we came down to about the low of Thursday and we ran up to the high, and there was also 10 o'clock news. So I was eyeing this bearish fair value gap, and I wanted to see the morning, this 9 a.m. candle close above that hourly bearish fair value gap, get back to the midnight open, and then we'd start to use this hourly fair value gap as support. And we did do that. Why did the morning not really move until noon? Is because London expanded lower. I talked about this last week. If you see the previous session trend a lot, have lower expectations for the next session. It's not always like, oh, if the previous session left a large trend, and how do you determine that? You just go back to the last 4 or 5 London sessions, or whatever session you're identifying, and you just take the average. If it's bigger than the average, a lot bigger, have lower expectation for the next session, which would be the AM session if you're using London. But sometimes it'll continue to trend higher, and most of the time it just won't, right? Because there's already been a big trend, and so failure to get down beneath this low. Obviously, I was wanting to see higher prices because I had unfinished business with this high, and we did do that. We cleared that high, but yeah, it will only happen in the afternoon where the run was nice and clear. So this is a London session. Obviously, you can see it's pretty huge. Compare that to other London sessions, it's a lot bigger. And now I'm using the proper premium to discount of a dealing range. So from that high down to that low, that's the high I took out buy side liquidity, low I took out sell side liquidity. That's a dealing range. And I'm using 50%. You can see how every time we come to 50%, we find a lot of support. And yeah, so noon right here, it has one run beneath the short-term low in discount, hitting this order block before running higher, and so you could have looked for trades around 11 to position yourself for the afternoon, or else the pre-market would have been nice. And yeah, when London session expands, sometimes the pre-market can be nice leading into 9:30, and then after 9:30, most of the traders get on and they all get chopped up. So yeah, usually if you see London session trend, it doesn't mean the pre-market's going to be bad, but you had a nice reversal during pre-market, which led into 9:30 higher into a premium. So notice the A is the pre-market and the B is the noon session, right? So around lunchtime, we closed above this inverse fair value gap. This was a run that ran the short-term stop. So remember, this ran the short-term stop on 15-minute chart, hit a discount PD array on higher time frame, and then that it was also in a discount underneath equilibrium, left a big fair value gap on its way down there. As soon as we close above it, notice how we just slice through it. We don't just find initial resistance. We just slice through it. We use this fair value gap as support and continue to run higher to the buy side liquidity. Okay. Same thing over here, right? We have an initial short-term low, right? We slice down to the higher time frame PD array, and then we have the inverse fair value gap. That inverse fair value gap, we have a fair value gap here. We have order blocks, whatever you want to use, right? You can use it to run higher, and then see it run higher into the whole rest of the day, to be honest. But which one of these were better, right? Obviously, the A one was better because why? We were lower into the dealing range. So you're positioned a lot lower in the dealing range, and it was, the risk to reward was a lot better for the A. So you have usually a higher probability of seeing profit the lower in the dealing range you position yourself. However, yeah, it was not too late in the B setup. It was probably a lot shorter of a trade, but a lot less points because you're getting in much, much later. This is the 1 minute chart for the pre-market. It's just for my reference. And then the B. So some of the things that I kind of reinforced this week was, even if you can find setups ahead of the higher impact news, try and paper them and have lower expectation for them to work out, because it's likely that they won't, and you might get chopped up and stuck into consolidation. And be careful too with the same thing after these huge moves, whether it's the news or a London session, right? Have lower expectations for the next session. And basically, this news week was very weirdly positioned. So, right, usually we don't have CPI and FOMC in the same day, and PPI the next day. So because of that, most of this week was a no trading day, and sometimes it's better to just completely avoid these weeks and paper trade them, right? Which is what I did most of the week. Anyways, thank you very much, and have a great rest of the week, and good luck next week. I'll see you next week.